Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Good morning and welcome to today's webcast, Not-for-Profit Tax, Spring 2016 Update. I'm happy to introduce today's speakers, Patty Mayer and Rebecca Griffith. Patty provides tax and related tax planning services for not-for-profit organizations. She is a frequent presenter about various non-profit tax topics at the University of San Diego Nonprofit Governance Symposium, the Salk Institute Tax Seminar on Private Foundations, the Moss Adams Webcast Series and not-for-profit seminars, and counsel on foundations, national and regional meetings, and presenter for the National Business Institute and Stratford Publishing. Rebecca provides tax compliance and other tax matter consulting services to a wide variety of not-for-profit clients, including public charities, credit unions, colleges and universities, and other not-for-profit entities. Rebecca also has extensive experience advising not-for-profit organizations on Form 990 and 990T reporting issues, lobbying and political activities, unrelated business income, related organizations and taxable subsidiaries, obtaining and maintaining tax-exempt status, and uncertain tax positions. In today's presentation, we'll be covering IRS updates, news from Treasury, new and proposed legislation, 990 and 990T highlights, and other current developments. And we'll kick things off with our first polling question is, what type of organization do you represent? Your options are private foundation, private operating foundation, public charity, other not-for-profit organization, a Moss Adams employee, or other. And I'll give you a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. And let's take a look at our results. Patty, I'll pass it back to you for comment.
Okay, good morning, everybody. Good to be here. We're going to start off with IRS updates. And to kick off this slide, well, first thing I want to say this is there is a lot of material on some of these slides, and it's intended more for you if you want to read more. You can download the PowerPoint and have that as a resource. We've also got some attachments of a couple of our newsletters that relate to a few topics in this presentation, but we do have a really good variety of different newsletters on our website that are specific to nonprofit organizations. So looking at the leadership team for this sector, we've got the IRS Overall Commissioner, John, Cynthia is the Tax-Exempt and Governmental Entity Commissioners, and she is actually the person that does a letter for the IRS work plan. So she's in charge of, they have a work plan that we're going to go over, and that is the IRS's a statement to the general public on what they're going to be focusing on, what's important to them, and ideas that they have, things that they're looking at. So it's a really nice roadmap to help us see what the IRS is doing. Then we've got Donna, Deputy Commissioner. Now Tammy, she is the EO Division Director, and she took over Lois Lerner when Lois was involved with the Tea Party scandal, I'll call it that. So Lois came out and Tammy came on, but we're not sure if she's going to be staying in this sector because she was on leave 6 months somewhere else. Don't know if she's being groomed. She did present in Chicago this month, so hopefully we'll keep her some more. Then you got Jeffrey, Margaret. The council offices, they're split into two different categories. One, they do guidance and regulations, and the other one is audits, litigation, and other case matters. So, okay, I wonder what happened to that slide. There it is. I didn't know it was flying. Okay. Oops, sorry about that. Okay, I got to do it one more time. Okay, so the IRS in itself is shrinking quite a bit. You may have heard this already. Well, they've got 24,000 applicants that are trying to retire, and they're on backlog. And the IRS does not have authority to rehire. So some of the scary parts of the IRS losing such a big part of its workforce, people retiring, is they're losing knowledge. A lot of these people have been in the IRS. They've seen all the different legislation passed, law changes, and we're losing them. The new people coming aboard do not have that knowledge base. So it makes it trickier for the IRS to run their operations. They had a budget cut of 4.3%, and Congress is wanting more money spent on customer service to make sure the general public is happy with them, cybersecurity, and identity theft. So the approach the IRS is doing to say, hey, we're losing people, we don't have this manpower, so they're looking to more automation, analytics, data-driven approaches to target high risk. If we look at the audit rates, this is kind of interesting. It also shows you how the IRS has slowed down a bit. But in the tax-exempt organization arena, if we look at 2012, they covered 1.34% of the returns were under audit. So that, and then it went up a little bit in 13 to 1.37, dropped in 2014 and also 2015. So there's quite a bit of a drop for 15. So the next few slides are going to be going over the IRS work plan, and this is a plan on a fiscal year, and it's through the year ending June of 2016. But what the IRS is doing is they've been working on this for a few years, but it's establishing a knowledge management system, and this is where they're gathering data from the old school people that are leaving. So they want to capture, hey, how are you doing things? What kind of tricks do you know? How can we put this into buckets to help train our other people? They want to serve customers better, and this is what Congress is mandating as well. And I have some examples on the next slide. And then they're trying to gain efficiency on how they're processing things, how they're conducting an audit, closing an examination, speed it up, don't make it take so long, because they don't have resources. So continuous improvement is one of their goals. So what they've done, if you are trying to apply for exempt status and you need a determination letter, now they're bypassing managers and other agents approving. It's going directly to a specialist to take a look at it. The other change that they've made in their process is It used to be, I'm a new organization, I send in my 1023 to receive exempt status. They have questions. Typically it was, I had 90 days when I got the questionnaire to respond to them. Well, now that 90 days has shortened to 35 days to respond, or my application gets suspended or closed. So they're speeding us up too. If we look at data-driven decision making, what this is, it's going really back to the basics. We're going to analyze the data. That's the future. So what the IRS had been doing when they had more resources, if you look at the college and university study, that was a multi-year project, started with questionnaires going out to the general public. Those were reviewed, examinations were pulled, that was reviewed, an interim study was printed, and then a final report was printed. Many, many, many years. They learned a lot, but that's so time-consuming for them that they're saying, you know, we can't really keep working that way, so we're going to have triggers. What looks suspicious? What is our high-risk area? So they're going to use the 990, and they're trying to make it in a more readable e-file format so they can pull data, look and see what's high risk, and then those are the ones that they want to come knocking on your door. Say, for example, you file your 990 and you report independent contractor expense for something, and you have wages reported on your functional expense. However, you have not filed any W-2s or 1099s. That's going to be a trigger for them. So just things like that. There's a whole bunch of them. Or say you have a material diversion of an asset that you had to respond yes to that and explain. That's going to be suspicious to the IRS. They might come and talk to you. So the other things that they're doing is they're going to be evaluating some of their long-term projects, and the first one listed is the Form 1023-EZ. This is an application for exempt status recognition, but only small organizations can use this. You do it online. It's a very short form. You do not submit your governing documents. You just answer some questions. And if you are going to use this, you have to start with a checklist to see if you qualify, because not every small organization can still use this. But what they've done on this is they said right now they're going to be conducting correspondent audits to see how this is working, since they are not asking for a lot of detail. They want to make sure the organizations that are filing under this are actually doing what they're saying and they're complying with the law. But they did give small organizations a break. They reduced the user fee from $400 to $275. And what they noticed was, out of the first year in using the Form 1023-EZ, 52% of all the applications they received were using this form. So that's also helped speed up the IRS processes. And so they're happy with that so far. So hopefully their audit will show people are complying. Oops, I'm sorry, I forgot to finish this slide. So I think I mentioned that, yet more modernizing e-file format. They want to make sure the forms have digital functionality, and again, this is so they can do their analytical data to see if something looks out of whack. And they're also trying to refine what they request if you are under audit. There's an information document request, so they're trying to streamline that so they don't waste their time or your time if you're under audit. There's 5 strategic areas that the IRS is looking at. The first one is exemption. Are you really doing your exempt activity? Do you have a non-exempt purpose that you're doing? Is there private annulment? Or private annulment would be where you're getting benefit from the organization, and really it should be for the general public, not just for insiders. They're going to be looking at this through field examinations. Protection of assets is very, very important to the IRS, and they're looking at things like self-dealing, if you have transactions with insiders and there could be an excess benefit, and that's typically, what that means is someone received more than market value. So a perfect example of that is compensation. I'm paid by a nonprofit, but I'm paid higher than the going rate for my actual duties. That excess could be considered an excess benefit transaction. They're looking at that. Loans to disqualified persons. And what they're going to be doing is this is going to be looked at through correspondence audits where you get a letter, sort of like a questionnaire to fill out. They may want information. Then it may lead to audits and field examinations. Tax gaps is the third one. And on a tax gap, the first item listed is employment tax. The IRS has actually been looking at this for a long time, a few years at least, and it's mainly the classification between an employee versus an independent contractor. So the employment taxes, the IRS's Social Security isn't getting their FICA, Medicare isn't being paid in by the employer where they automatically withhold it from the W-2. The independent contractor has that responsibility. So the IRS loves everybody being an employee because they know they get their money. They're not quite as happy if it's an independent contractor and want to make sure you're really allowed to be that. Unrelated business income tax is another big focus. Well, when the IRS completed their college and university report, their final report, there was unrelated business income tax was a huge finding, that there were a lot of errors going on with the universities, and not, pretty much they figure everybody's doing this, not just the universities, but some of the key areas were allocation of expenditures and net operating losses. So they know that they're not getting the taxes that they think should be paid, and it's fine if you have to pay that as long as it doesn't take over your whole organization. They're also going to be looking at this through compliance checks, correspondence audits, and field examinations. The last two are strategies is international activity. The government is fine with you doing international activity. They're just very concerned that the charity has control over the money and it's being spent for charitable purposes. That's the main thing. It's not being diverted to terrorists, things like that. They're also looking at the FBAR requirements, and FBAR is foreign bank accounts. If you have $10,000 anytime during the year at a foreign bank, you need to disclose on a form. Also, if you have signature authority, things like that. And if you do have any of those, just a reminder, it's due the end of the month, June 30th, and has to be filed electronically. So these international checks, again, they're looking at compliance checks, correspondence audits, and field exams. The last section of a strategy is emerging issues, and they're looking at non-exempt charitable trusts and Section 501R. 501R relates to hospital requirements where they want to be a 501c3 public charity, but they have to meet certain standards like community health needs assessment, patient charges, collections, things like that. And just to mention, this just happened, or this got printed this month. I read this June 9th, so it's very new. But Senator Grassley, you probably have heard of him. He is the senator of Iowa, and he also had questions about hospitals and colleges and universities. On the hospital side, he sent out his own questionnaires to different hospitals. Well, then he became the ambassador to China. Well, he's stirring up things again. As I said, he's putting a stick in a bush, see what comes out. But his latest thing is he's asking the IRS for updates on how they're implementing tax-exempt hospital accountability measures. And he cited 2 hospitals that were aggressively suing patients. So it was collection in the collection area. So we haven't heard the last of him. He's going to be asking a lot of questions, so that's out there. Another area that the IRS is looking at is employee benefit plans. They're looking at large plans right now, and they're also going to be doing several new compliance projects, looking at data, past projects, law changes, things like that. Governmental entities is another area, and it's kind of interesting. They call a small governmental agency one that has gross wages of $10 million or more. That's what they're going to be. 75% of the money is going to be following those entities. Then they're looking at larger ones of $100 million and more in gross wages. So what's interesting is they've identified high-risk areas, saying that, okay, early retirement incentive plans, there's a high risk of noncompliance, rapid growth, reduction in payroll reporting, increase in 1099. So that's kind of what I said earlier. Is that right? Should they be more W-2s than 1099s? That looks fishy to the IRS. They're also going to be looking at tax-exempt bonds, and about 20% of what they look at is really from claims, referrals, whistleblowers, things like that. That triggers it. They've done a lot of work in different subsets within the tax-exempt bond area, and now what they're thinking of doing too is they call it a soft letter program. When you issue a tax-exempt bond is issued, the form 8038 is filed, and just by the IRS looking at that initial form can trigger a lot of questions. So that is, we're going to be seeing that as well. Other couple of things, there's a advisory committee on tax-exempt and governmental entities. They're called ACT. They did not add any new members for this summer. The members are volunteers. They don't get paid for being on the committee, but they do get travel costs reimbursed. But it's all at governmental rates, so it's not like it's a big windfall if you're on this. So now the membership is 15 instead of 21. Schedule B, let's talk about that one. So Schedule B is the schedule on your Form 990 that lists the donor's name and address and dollar amount of cash or non-cash contributions coming in if it's $5,000 or more, or if you have a special, if you're a certain organization and you can report just the high-level contributions coming in. Regardless, we have been stuck with it for a very long time with all of the clients that we work with. Well, what's interesting is the House just passed a bill, and what they're looking at is they're saying, well, and the IRS was even questioning, like, why do we even have to have Schedule B? There's no matching element with this. It's not like if a 1099 gets issued, say for your personal return. You get a 1099, you file your 1040, the IRS kicks out a letter and said, hey, you forgot dividends of $1,000 from X corporation. They can match. Well, on the Schedule B 990, it's the exempt organization's method of accounting. So they could be recording a pledge as money coming in that really the cash hasn't been received yet, and the donor isn't deducting it yet. So there isn't really a matching element. Well, the House says, okay, well, what they're saying is, okay, we don't really think the IRS should have this information, and they're looking at it more from the 501c4's where the IRS was very aggressive, targeting these political groups, asking for lists of donors, things like that. So they feel like, well, the IRS shouldn't really have all that information. It's more freedom to the individuals. Couple of caveats that are out there right now is they would want reporting from officers, directors, and employees that are the top 5 employees of the organization. So contributions coming in from them, and then also if there's some sort of tax shelter or abusive transaction, they still want disclosure of who was involved with that, so it doesn't get rid of that. So that'll be interesting to watch. You may not have known this, but if you had free time and you said, hey, what's the IRS thinking about? They actually have virtual workshop programs. Here's a list of what's on there right now, but so the IRS really is giving a try to provide more education. They're using electronic media. They're trying to get out there so we all understand. Okay. Emily.
All right. Our second polling question is, which IRS focus area is of most interest to you or your organization? Your options are exemption, protection of assets, tax gap, international, or emerging issues. And just as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And let's take a look at the results. Patty, back to you.
Oh, okay, thank you. All right. So news from Treasury. First slide is the priority guidance plan. This is where the Department of Treasury focuses for the 12-month period. What are they going to help out on? What type of projects? Well, you'll see from the next couple of slides, they aren't super speedy in this area. I think other things might come up that pull them away. But out of the 13 projects for tax-exempt organizations, 12 of them were rolling over from the prior year. If we look at the first one, this has been on their plate since 2008. So not really, it's the #1 priority, but they haven't really worked on it for Reliance. The next one, Select Check, that one actually, we're hoping that they do update that. It really shouldn't be too difficult, hopefully, for them. But basically what it says is Select Check has taken over publication 78, and that's to determine if the organization where a donor can look up and see, oh, are you a public charity? Are you a private foundation? Have you lost your exempt status? Are you in good standing? So, and we don't have publication 78 anymore. They want to do regulations for political organizations, supporting organizations, and they did actually issue guidance, proposed regulations in February 19, 2016, so they've moved ahead a little bit there. They want guidance on allocating expenses relating to dual-use facilities, and this is with respect to unrelated business income tax. I'd mentioned on the college and university report allocation of expenses. The IRS saw a big problem there. So if you have programmatic plus unrelated, they want to make sure it's being done correctly. And they've actually asked the AICPA for examples on that. They want regulations for the ABLE program, that's Achieving a Better Life for Disabled Individuals. That was passed December 2014. And it's a tax advantage savings account for disabled people. Guidance on investment in a partnership with disqualified persons. Good faith determination standards, we can check this one off. They did final regulations in September 2015. Next one, program-related investments, final regs. Another check off for them, Department of Treasury, good job. This one was passed in April of 16. Excise tax on donor advised funds, this has been on the table for 9 years, so we're still waiting on that one. And guidance for reporting contributions, Rebecca's going to talk about a little bit of guidance that went out if she has time, and then you can see what happened with that. Final regulations on Section 6105. This has been on the plate for 5 years. It has to do with termination tax for a private foundation and how publication goes to state officials. And lastly, church tax inquiries. That's been on their list for about 6 years. So the guidance for program-related investments, this was really, really nice to get some more guidance from Treasury on this. The last time guidance was issued in the regulations was 1972. And what program-related investments is, you can hear it both on the public charity side and private foundation. In the private foundation arena, there's specific rules in something qualifying as a program-related investment. They get to take it as a qualifying distribution, and they have to do expenditure responsibility. There's all these rules. Primary purpose is to accomplish a charitable purpose. You see it in the investments can be an equity position, buying stock, getting in a partnership, or making a loan. Those are typically what you see. Well, what they did is they added 9 new examples. So, you think from 1972 till now, a lot of things have changed in the business world. So that was good to have. Some of their examples are you're a business enterprise, you're investing stock in a business enterprise, and they're doing research and developing new drugs. So maybe you have a lesser return than a commercial investment, but you're doing it for a charitable purpose. So it's not a jeopardizing investment. You won't have an excise tax, and as long as you follow all the rules, you're fine. Maybe another example, you're purchasing stock in a foreign solid waste recycling company or providing them loans. You're extending credit to an economically disadvantaged area that was hit by a national disaster, or microloans to poor countries, helping farmers, educating them. So all those type of good things. So that's nice to have. The other guidance, final regulations on good faith determinations. This one we actually have in your attachments, or what do you call it, your hashtag at the bottom. You can download a newsletter that we have on this one if you want to take a look at that. But basically what they did is if a private foundation makes a grant to a foreign organization, public charities also want to make sure they have good rules and procedures on anything going out of the United States. So it's a good rule of thumb to look at the private foundation rules. If you don't have your own rules, that's good guidance on things to follow. But basically, you could give a grant to a foreign organization and do a determination that, hey, if they were organized in the United States, they would be a 501c3 public charity under our rules. Well, now they used to rely on outside counsel, foreign counsel, determination by the grantee. Now they've said, no, we're not going to let you do it. It has to be done by U.S. people, but they expanded the class. So it could be not just an attorney, it could be an enrolled agent or a CPA that's subject to Circular 230. And then if it was a foreign attorney, they would have to be subject to our U.S. laws. So there's more on that if you want to read it, if that's applicable. Okay, new and proposed legislation. We're going to go, Where'd it go? Oh, sorry. I'm having a little problem with my slides. Okay, the path that we're just going to go over some of the bolded items. You're all pretty familiar with these. But this was passed December 2015, and it was really, really well received. It made a lot of provisions permanent instead of, oh, it's going to expire. Oh, okay, you can have it another year. Oh, it's going to expire. So now we know the rules. And one of the biggest ones that was really highly favorable to the nonprofits was the IRA distributions. And so on the IRA distributions, that needs to go to a qualified charity, which are usually your public charities, the 50% charities, not private foundation or donor advised funds. And the other trick, you have to be this certain age, 70 and a half, $100,000 per taxpayer can go in. But one of the big things is the taxpayer cannot receive a return benefit back. So they can't get anything back from doing this. Otherwise, it taints the whole transfer and it won't work. So just watch out for that one. Capital gains for conservation purposes, that's permanent. Payments to controlling organizations, that's back from the Pension Protection Act of 2006. Contracts in place then, they're saying, all right, if you still have that contract, you're okay. Food inventory contributions, basis for S corporations, that their adjusted basis just goes by the, not by fair market value, but they look at basis. One of the changes, too, for employee W-2s and 1099s, they're changing the due date to January 31st. That's submission to the IRS. It was always the due date to get the information out to the individuals, but now they've, instead of February 28th, it's January 31st. The same time. Employer identification, if you're getting a credit, you have to provide the educational institution's ID number. And then for higher education, they changed the reporting for the Form 1098-T, and this would be reporting qualified tuition and related expenses. Well, now it has to be actual expenses made, and so it could be different data collection from the universities. Cash basis. Let's see, the 501c4 political organizations had a new notification requirement 60 days after creation. And this was connected to the law. Well, they actually issued a notice saying, all right, if you're formed within 60 days, we're not going to make you do this yet. We're going to come up with temporary regulations. Then the trigger starts. So they haven't really pushed this out all the way yet. Gifts by certain exempt organizations. It was always a question if you are giving money to a business league or a political organization, a labor organization, have you made a gift? Because you haven't made a contribution. So now it's clear that they are not considered gifts. All right, next polling.
Okay, our third polling question is, does your organization solicit donors from donors' IRAs? Your options are yes, no, or not applicable. And for those of you that would like a copy of today's slide deck or the materials that Patty has referenced earlier, you can download them from the folder that says Slide Deck and Handouts at the bottom of your screen. We'll also be sending the slides via email after the webcast. And let's take a look at the results. Patty, back to you.
Okay, so there's a lot of no's. You might want to rethink that because that's a new one. You can get money from their IRAs. Something to put on the table. I mentioned these two already in the extension for the C4, 60 days. Also, the supporting organizations, they did issue some regulations, proposed regulations for more guidance. The charity bill on the Senate side, let me click all these. This one, what they're doing is, the first one is they want donor advised funds to IRA rollovers to be able to go into a donor advised fund is one of the items. They also want disclosure of inactive funds from the donor advised funds. So is there a policy? How is the sponsoring organization handling that? They have to disclose if they're not doing anything. Private foundation excise tax to 1%. This has been in a lot of legislation, just hasn't passed yet. The rates fluctuated from 1 to 1.35%. Electronic filing for Form 990s. It's required for large organizations now. That charity volunteer mileage can be, Department of Treasury can regulate that, and excise business holding tax rules for philanthropic businesses give some relief there. The House also, the first one listed, they're also pushing for donor advised funds, IRA money, to come into those. And the second one listed, this is kind of interesting, that you know when you get a 1099 and maybe you earn $2 or $1 or $15 or something. Well, it's a bill to say if you just donate that to a charity, you don't have to pick it up as income. So it might be a real windfall for organizations to get some money if this does go through. It's less than the $100,000. You might be able to solicit better. Charitable Giving Protection Act. They don't want Social Security numbers on acknowledgement of receipts. And a CREATE Act is where an artist can deduct the market value of their works instead of the cost of the materials. And I'll pass it to Rebecca.
Great, thanks, Patty. So we'll turn now to some things that may be closer at hand and some things you can look at as you prepare this year's 990 and 990T. This is generally the part of the presentation where we would go in depth on the changes to the 2015 Form 990 and schedules. But the good news is that there really were no significant changes to the forms themselves. So that's great for administrative purposes and compliance purposes. There were several clarifications in the instructions, as there always are each year. But the entirety of what changed is just on these two slides. So we won't even go through them. They're there if you think something applies to you. Check out the What's New section in the instructions for those schedules and see if anything could change in your reporting. I thought a better use of our time then would be to go over some common mistakes that we see on Form 990. We see a lot of 990s. We see them from our own clients, from other CPA firms. So there's just a couple of slides here of things that you might want to go back and review your own 990 or think about them for the one that you will file this year. So first off, something we're hearing from the IRS is that 990 filers are providing Social Security numbers on the 990. Don't do this. They're not asked for any place on the 990. They're not required, and it's certainly information that nobody wants to be public. The IRS has to go through some pretty to great lengths to redact that information. So make sure you're not including that information. The next three relate to governance section of the 990 in Part 6, and this is not really a numbers section, it's more of a free form, so that's why we see a lot of differences in how things are reported. Section A, line 1B, says ask for the number of independent voting members of the board. And like so many things in the 990, certain words mean specific things just in the world of the 990. And so independent is a key phrase here. It doesn't mean that the board member lacks dependence and therefore can't serve on the board of the organization. Rather, you want to look at things like whether the voting board members are compensated, what they're compensated for, how much they're compensated, whether they are listed in Schedule L as having outside business transactions with the organization and related organizations. So independent means something really specific here. It's worth a look to see if any of your board members really are independent or not. Governance policies in Section B of Part 6 These are yes-no questions, generally, about different policies an organization might have. Compensation setting, conflict of interest. It's important to note that these are not questions of law. Organizations are not required by law to have these sorts of policies in place, but generally answering yes, that these policies are in place, is a sign of good governance for the organization, and it shows that the organization is really taking steps to mitigate risks and protecting its assets and its tax exemption. So the policies here, you want to answer them yes if you can, and but certain criteria have to be met for that. They have to be written, but that doesn't have to be formal. Documentation in minutes is okay. But they do have to be in place by the end of the tax reporting year for the year you're reporting. So you can't retroactively adopt something just because you want to answer yes. So keep that in mind, especially if you're a June 30 year-end and you're coming up on year-end. There may be some time to get some of these policies in place so you can report them on the 990. Public disclosure, Form 990, that's Part 6, Section C, number 18. We see this one all the time. There's a box to check that 990 is available on another's website. GuideStar does not count for checking another's website. It has to be an organization you've provided your 990 to, and your 990 is going to GuideStar whether you want it to or not, generally. So keep that in mind. The next two are compensation issues. Part 7 is a really complex part of the form, and it's got lots of complexities. These two items in particular we see not handled so consistently. So the idea of a former officer, director, and key employee, if you're familiar with Part 7, you have to put each person who's listed in a bucket: officer, director, key employee, highest compensated employee, or former of any of those except for highest compensated. But former here, again, really means something really specific for the 990, and it's defined in the 990 instructions over a page or two of instructions. The key is that it doesn't just mean that someone is no longer an officer, say. We'll use the CEO as an example. If you have a December year-end organization and the CEO left in May, they're no longer an employee, but they're not yet former for the 2015 990 because they were still employed during that year. That's a current employee in the 990 world. So you have to look at the timing of the departure of the employee or the director. You may have to compare calendar compensation versus fiscal year compensation to determine if they have to be reported at all. And then there are special situations and instructions for when, as an example, an officer changes positions at the organization and is no longer an officer, but is still an employee and maybe isn't a key employee or highest compensated. So lots of details there in how to report. If you do have turnover, that's always a great time to kind of go back and check off all the rules and see what applies. Third-party compensation, this can arise if you have more complex compensation structures, like management companies or compensation from related organizations, or compensation from unrelated organizations for services provided to your organization. This is one thing that's not even very well explained in the 990 instructions themselves. There are some examples there, and if you're lucky enough to have your circumstances fit those examples exactly, then the instructions are helpful. But otherwise, it can be a little murky. The instructions reference common law employee, which is a state law concept, so that's not even defined. So when in doubt, take your best effort at reporting things correctly, and if it's unsure or unclear, you can always use Schedule O to further explain the situation. Next item is a revenue item, Part 8. This is contribution versus program revenue, and this has implications not only for reporting in Part 8, but also for passing your public support test if you're a public charity. So contribution revenue is reported on line 1. Program revenue is reported on line 2 of Part 8. And an example of where this can get confusing is if there is a contract with a government entity. Part of that contract may be that the government entity is funding the tax-exempt organization. The organization then provides its tax-exempt services for the good of the general public. Contrast that with government entity having a contract with a tax-exempt organization. Money goes to the organization, but the organization provides services back to the government entity. So we're kind of looking at one-way revenue where no benefit is received back versus two-way revenue in exchange for services. A lot of times this takes some pretty detailed review of the contracts. It doesn't matter if it's called a contract, called a grant, called a contribution. You really need to look at the root of how this revenue is generated and what's happening after it's generated. Schedule A, Public Foundation Classification, seems like it would be a pretty easy one, but for older organizations where the people who first applied for tax exemption for the organization are no longer around, maybe that initial IRS tax exemption letter can't be found, and then someone's come along and interpreted something differently. This can have effects if you're not reporting what the IRS thinks you are in terms of passing your public support test. You can look up on the IRS business master file what the IRS thinks the organization is, and it's a good idea to check that every once in a while just to make sure the IRS has the right information and you're reporting correctly. Donor disclosure on Schedule B. Patty talked a little bit about this and some potential changes to Schedule B. Just be aware of the thresholds and making sure you're not reporting more than you have to. Certainly this is another place where don't include Social Security numbers. And remember that names and addresses are not required to be made available for public inspection. That never has to be put out to the public. Foreign forms for Schedule F Part 4. We see this a lot for endowments that have alternative investments. The questions there ask if the organization has ownership interests in these foreign entities, and it references form numbers that may have to be filed. The key here is that it's asking if there are ownership interests, not if the forms have to be filed. Those forms may not have to be filed due to reporting thresholds. Tax-exempt bonds, we could have a whole slide on common mistakes and how confusing Schedule K is. Proceeds are what we've called out here because Part 2 proceeds, the numbers don't add up always to the total proceeds, and it can be a little confusing. We recommend going back to the form that Patty mentioned, 8038. That's always filed for any tax-exempt bond issue with the IRS and should be part of the bond documents if you've got a copy on file. That's going to help get things into the right lines on Schedule K, Part 2. Business transactions with interested persons. This is on Schedule L, Part 4. And I think the biggest thing here is making sure that you are looking at the correct pool of people, all of these different people who make up interested persons. It's pretty easy to understand that you look to 990 Part 7 for your officers, directors, and key employees. Those are interested persons. The instructions for Schedule L actually were updated quite a bit for the 2014 reporting year, and they then included the creator and founder of the organization, as well as any donor who's listed on Schedule B. Those are considered, for that tax year, those are considered substantial contributors, and you have to analyze that group of people to see if they have any other business transactions with the organization. So it's those groups of people as well as family members of all of those people, and 35% controlled entities of all of those people. So it takes a little bit of mapping and understanding the different buckets, and then you have to make a reasonable effort to either know or learn, whether that's from other information or from those people directly, whether they have any business transactions with the organization. This can be a little onerous, and one of the changes the IRS made to the Schedule L instructions is that they did increase the amount of time that they expect Schedule L to take. So that's no surprise. It's a big undertaking, but another good reason to make sure you are applying the correct thresholds on Schedule B, because Schedule B donors could be quite a big pool of people that you need to consider for business transactions. And then transactions with related organizations in Schedule R Part 5. Look at whether you're dealing with a controlled organization, an exempt organization, a disregarded entity. Some of these aren't required to be reported at all. Some have thresholds. So that takes a little bit of mapping out as well. I think the thing to remember here is that no one of these things is a red flag. This is much different than a for-profit tax return where one mistake could cause a change in tax. The IRS is very interested in that, of course. For these things, if you notice any of those things and think that you might need to look at them further, make a good faith effort to correct them, and going forward, you can look at prior year returns to see if it was misleading enough or something the IRS would be super interested in, to see if you need to amend those prior year returns to make the corrections. But in general, no one thing is a red flag. Instead, the IRS looks for fact patterns and combinations. Patty talked about their data-driven audit selection. And so if you've got, as an example, yes to family and business relationships in Part 6, you have very few independent board members, and you have significant Schedule L transactions, the IRS computer could put this together and say, okay, this is a situation where there could be potential here for excess benefit transaction for some of these people who are not independent and have these transactions. So think of it more of how these items connect to other items and what they say about the organization, and instead of just whether you're doing them or not. Form 990T and unrelated business income, wanted to touch on that real quick. The IRS really hasn't changed what they're interested in over the past few years. And Patty talked about this in her priority guidance plan of what they're looking at. There's a couple of issues here. The first one really is, how much UBI is too much is too much. This is not necessarily how much tax you're paying, but it's a tax exemption issue. Are you really acting like a for-profit company, or are these activities really insignificant to the whole picture? The other ones have to do with expense allocation that Patty talked about, and a history of losses. You've got to have a profit motive, and then to be able to support those net operating losses when used, even if those losses were generated 10, 15 years ago. So these are the kinds of things the IRS will be maybe looking at in correspondence audit if they do that. Now they're understaffed and getting smaller, so it remains to be seen how much of this they'll look at. And they really are looking for, those organizations that are really gross negligence. They're looking for big fish. But it's worth, looking through this, documenting your positions and your expense allocations, looking back at your losses, so you have an idea of what the IRS will ask for if they come knocking. We'll have our last polling question here next, and in the interest of time, we'll have to skip our last section, other current developments, but please do review those slides. There's just kind of a hodgepodge of other things we wanted you to be aware of, including changing tax return due dates for the 2016 returns, the charitable giving reporting legislation that was proposed but got shut down, which is good news, changes to Department of Labor overtime regulations, and then some endowment activity that both Congress and Senate are looking at for colleges and universities with large endowments. So please do reach out with any questions on any of that. Otherwise, I'll send it back to Emily for our last polling question.
All right. Thank you, Rebecca. And our final polling question for today is, have you ever included a Social Security number on Form 990? And your options are yes, no, or not applicable. And if you have completed all CPE requirements for today, you'll be able to download a PDF of your CPE certificate from the certification icon at the bottom of your screen. And as a reminder, this is the last polling question. Let's take a look at the results. So it looks like you guys all had the right answer here. And with that, I will thank you, Patty and Rebecca, for a great presentation. If you did have questions for today, we will be happy to follow up with you via email after the webcast. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive credit today. If you participated as an individual and met all CPE certification requirements, your certificate is available to download now in the CPE icon at the bottom of your screen. Open the icon and click the printer in the lower right corner to download a PDF copy now. I'll keep the webcast console open for a few minutes to give you time to download this. A copy will be emailed within 2 weeks should you have any difficulty downloading it at the moment. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.